Bahram, welcome. Before we get into this, I wanted to quickly tell you about my haircut. My son, this weekend when we were going for a haircut, he asked me to get the Ronaldo cut. It's a low cost decision. But when you're 25, you made a decision which was much less reversible. You had just sold your company and then you lost a bunch of money investing it. But then you decided to double down.
No, I mean, I was always interested in businesses, business models, and investing to begin with. That's why after I sold my business, I went into investing. So it was, of course, painful to lose most of the money that I had after the post-exit selling the business. But it only motivated me more because now like, okay, this didn't work. Why didn't it work? And so it just motivated me even more to try to understand businesses, how they work, why they succeed, why they don't succeed, and what that means from an investing point of view. So it only reinforced the path that I was going.
You had some data that you are not very good at this job, and then you decide to double down and say like, hey, I'm gonna do this more. Talk to me about like the confidence and where like how you thought about that.
Yeah. No, I mean, once you experience pain like that, for me, it was the motivation to really dig deep, right? I was like, okay, I thought I understand business and which businesses are worth how much. I had also listened to the wrong people. That was another thing. So I thought, okay, before doing more investing, I should really understand more about business. And I decided to move into consulting because I thought, in consulting, I'm dealing with businesses all the time from different industries, different geographies, getting to know their business models, their competition, how they try to succeed or not. And I thought, this expertise, understanding these businesses better is going to equip me to be able to choose between businesses from an investing point of view, like which businesses are better to invest in and which businesses are troubled and I should stay away from. So it was really I think the kick that I needed to go and say, okay, instead of being only on the surface of it, really dig deep and understand what makes businesses succeed or fail.
Then you did an interesting pivot. You kind of went and joined a Swiss, very respected Swiss management firm. In a room with the people you work with, and you basically asked them whether they would sell Apple shares at this price to you.
Mm-hmm.
And there was a very interesting discussion that ensued, and it led to some life-changing decisions for you.
I just saw that this is taking more and more of my time that I'm doing on the side. So my main job was being a consultant and helping businesses. But then, in the evenings and on the weekends, I would study more and go into investing. And then after a few years, this became so much that I thought, it's a little bit crazy. Maybe I should make that my profession. And the reason why I say this is when I went that way, I thought, I should join the investment management, the asset management industry and learn how they do it, right? Because I was doing it on the side, there's got to be a professional way of doing this. And while doing this, I also decided, after now I've been, I don't know, I was around 35 years old, I think by then. I thought, if I just go from consulting to investment management, who's going to hire me? With what qualification? Just saying, I did that on the side as a hobby. So I decided to go and join the CFA program and become a chartered financial analyst. So I learned the theoretical knowledge you need to know about investing. And while I was doing that, I thought, now I know enough that I think I can credibly go and, into interviews and talking. And in Switzerland, back then, I think there were about 5,000 asset managers, banks, wealth managers, things like that. So I thought, this is very fertile ground. I can find something. And it was interesting because I remember I found maybe a handful, maybe a little bit more than a handful of companies that just looking on their websites and their communications, I thought, there's something fundamental about how they do investing and it's not just gambling. Because everything else that I was finding, I was like, there's no concept, there's no discipline, I don't understand what they're doing other than, guessing around. So I decided to join a company that to me looked very reputable, and it was because they had done a lot of work on what it means to be a quality company, like what defines a quality company. And their approach was to invest in quality companies when they're attractively valued. They had written a book about it, and yeah, there was really a structured process of going through the universe and filtering it down to companies that are candidates, and then doing more detailed investment research to create a concentrated portfolio. So that's what attracted me. And when I started working there, so I had this background that a lot of people actually don't have a concept, but now there was an exception that I started working with. And when I was there, over time, as I got more and more experience, I was promoted to the investment committee and was also responsible for the investment decisions ultimately that we made. And this is when it came to the Apple situation. And in the Apple case, I remember the analyst had filtered through the universe and came up with Apple as an investment candidate. It turned out to be a few months before Steve Jobs died. And at that point in time, as one of the portfolio managers in the investment committee, I agreed to do this investment because it was a phenomenal business. It had a very strong brand. The iPhone had been on the market maybe 1.5 years, 2 years. It was doing very well. The iPad was already out. So there were a lot of things to actually like about the company. So I said, yeah, we should invest. The valuation looked attractive. And lo and behold, a few months later, Steve Jobs passed away. And at first, nothing really much happened. But I think about 6 months or 7, 8 months after Steve Jobs died, or maybe it was already a year after it, I don't remember quite, the stock started sliding, right? I remember there was an IDC study coming out that, they're losing market share in the tablet market. And it was like they had 27% and it became 25% or something like that. And the stock was just sliding and losing more and more. And that was when the investment committee first said, we think we should sell Apple. And I looked at the company, analyzed it a little bit more, and then I came to the conclusion.
You're not very convinced.
Yeah, I was like, no, this is still a very strong company. The valuation, the price has come down, but the business is doing very well. It's actually doing even better than before. So I started buying a little bit position for myself too, as on the private, because I like the things that I was convicted about. I'd like to also put my own money in. So I managed, I think for 2 months or 3 months, we had these monthly rhythms where investments were being discussed. I managed to convince the investment committee not to sell because the fundamentals of the business looked very strong. But then the stock fell even further. I think within 6 months, it had almost halved at that point. And then the investment committee, they wouldn't reason. They wouldn't listen to reason. So all the arguments that I brought, they were like, no, but
keeps falling, yeah.
Yeah, we need to sell. So, by that point, I had doubled down with my own personal money into Apple because I thought, with the strengths that this business has, the amount of ample cash that they have, and even back then, if you thought the retail distribution that Apple had with the Apple stores where you could go and touch the products is something that even to this day, this is now so many years later, still no company has the retail distribution and power that Apple has. So there were so many things there that I thought, at this price, it would be really a huge mistake to sell. And that's when I put in my veto, because to me, if we had sold Apple at that point, we would have done a very big disservice to our clients. And to me, it was very surprising that I couldn't communicate that, or I wasn't getting through to the investment committee that, this is now a really bargain price to sell at. Why would they do that? So after the veto, the investment committee was not happy with me. They summoned me and said, why, for months we're trying to sell, and now we're really convinced we should sell, and you're not being a team player. Tell us why, right? And that's where what you pointed out, I was like, okay, but now imagine you have this business, and imagine it's yours, right? You own 100% of Apple. You have this brand, you have these products that are having customer satisfaction scores that no other product has. You have the what do you call it, the network effects of the devices being
Supply
connected
chain.
together. No, I mean if you have the phone, and you might get the tablet.
The
if you have the
ecosystem.
tablet, the ecosystem that reinforces each other, and you have these enormous switching costs that you have, and they're going into services and doing all this kind of stuff. They have so much ample cash that they can invest. It's like, what is there not to like? If this was your business, and you're a businessman, and I would come to you and say, I have heard that you're the owner of Apple, and I'm willing to give you this price for it, right? Would you shake my hand and say thank you that you came to my office to make this great offer? Or would you show me the door and say, get out of my office? And they're like, yeah, we'll tell you to leave, right? I said, okay, but then why do we want to sell it for our clients? If as a private owner, you would say, get out of my office, what guts do you have to give me this ridiculous offer, right? Why are we selling at this price? And that's when they looked at me and they said, but it's not a private business. I said, what do you mean? It's like the stock can fall even more. And then that was when it rang to me, because I said, but we have 20 other businesses in our portfolio. They could just as easily fall. The argument that the stock can fall more cannot be a good reason. And I thought about this and I said, I still don't understand why they think that way. Until I actually understood that it's really the incentives that drive behavior very much. Even in an asset management company where there's a very good fundamental research going on in the concept and an approach to do disciplined investing, the incentives can get in your way. And that's where I realized, this management fee that is charged regardless of performance is actually a very lucrative fee. And when you think about it, you think, as a client, you think, okay, I'm handing over my money for somebody to manage, and it's in their best interest to invest it well. Well, on the surface, that is correct. But then in the details, it's a little bit different, because let's say a manager invests your money well, and your assets, you have 20% gains, right? With the 20% gains, they get 20% more management fee. Yeah, so that does incentivize them. So that's the upside. But then on the downside, if they perform, if they invest differently than the index that they're compared to, like the benchmark, and they perform differently, right? So let's say they underperform the market for some time, even in the short term, then the client is going to come and say, but I give you these fees to actively manage my portfolio. You underperform an index that I can just buy an ETF almost for free. So give me back my money, right? So your upside is maybe capped at 20%, 25%, 10%, whatever it is. Your downside is that the client takes the money away and your management fee is gone. So you have minus 100% downside risk, and the upside is limited. So with that, and because the communication between clients and stuff everything is a little bit on the short-term side. They don't really communicate to clients that, we can underperform a year or 2 or 3. That doesn't matter. You have to look at it over a cycle, because then it's very difficult to attract money, right? Everything becomes a little bit short-term, and that way a lot of asset managements have their hands tied behind their back. They can't really invest significantly differently than the benchmark or the index that they're being compared with. And in that case, in Apple, they just didn't want to look bad in front of clients to say, we're invested in this company, but it has gone down so far, and it might go down even further, right? So it takes you away from these fundamentals, and that's where I realize, as I said, that even the best-minded investors can really trip over their own incentives if the incentives are not set up correctly.
I think you're pointing out a very interesting thing. It's two-sided. One is that the structure itself, it's not geared towards being different from the market. The second one is actually you need to have the right set of clients who can believe in you long term, and they don't sell you when the stocks are down and when the chips are down.
Yeah. Well, I think what you mentioned is very important, the being able to diverge from the markets and behave differently than the markets. And it's worth asking why. right? Why should you invest differently than the market? Well, I mean, it depends on what your goals are, right? If your goal is to have good performance and average good performance is good enough
I mean,
for
just
you.
absolute good performance, right?
Yeah.
It's not nothing to do with the market.
Then you can also invest like the market, right? But if you want to have better than average performance, then two criteria have to be met. First, you have to be right in your decisions, or in most of your decisions. And secondly, you can't do what everybody else is doing on average, because if you're right and you're doing what the average does, you still get average results. So above average results have to be by definition right and different, right? So that's where you have to divert from the market if you want to have above average performance. But as we discussed, if you don't have the incentives right, it's very hard.
You need the ecosystem to support that, right?
You need to do that. So for me, the conclusion was very clear. If I'm going to start a business on my own, and if I want to aim for above average results, I have to have an incentive system that basically forces me to behave differently, to behave in the best interest of my clients, right? Because even if I have the right intentions and the incentives are not right, I'm going to drift, right? So for me, the first thing was, and that's also something that I saw when I was consulting businesses, right? I always saw that decisions were higher quality, better decisions when there was skin in the game, right? So whenever the decision maker was an owner or was thinking like an owner, they made better decisions than when they were just a manager and acting as an agent.
So you have to have your own money on the line, right?
Yeah, you have to have skin in the game. So for me, that meant, okay, in Richtwert, whenever I want to invest for clients, I have to also be a client at my own company. And that's something, the first principle that I had, that every client that comes to Richtwert knows that whatever I'm investing in for them, I'm going to do the same thing with my own money, right? And I have all my net worth. I mean, Richtwert belongs to me, but I'm a client at Richtwert too. So I have exactly my net worth and my family's net worth invested in the same portfolio as them. They know we sit in the same boat. We celebrate together, and if it doesn't go well, it hurts me as well. So that was principle number one. Principle number two was that I said to myself, I also want to make it fair in the partnership, right? I don't want to make money off of my clients, because when you can make money off of your clients, you start having incentives that are different than your clients too, right? So I said, okay, well, how can I make that? And to me, because I had seen the disservice that management fee can create, I said, okay, I'm going to get rid of any management fee. There's not going to be any management fee at Richtwert. So to be fair and to be success-based, you have to also define success. And the way I did that is I set a hurdle rate and said, okay, anything above this hurdle rate is going to be shared between the client and Richtwert. So the way it was set up in the beginning was the hurdle rate was 5%, and above that, anything that exceeded 5%, 25% would belong to Richtwert and 75% to the clients. And later on, a few years later, I increased the hurdle rate to make it fairer. I made it 6%. So basically, for the first 6%, Richtwert, my company, doesn't earn anything. Everything goes to the client. If we perform in a year above 6%, then the client gets the first 6% and 75% of the performance that exceeds 6%, and 25% of the performance exceeding 6% goes to Richtwert, right? So that's why it's purely success-based, and I'm motivated to do a good job for them. Of course, any losses are carried forward. They have to be made up for. On top, 6% has to be earned before Richtwert gets any.
It's very interesting. This incentivizes you more towards not maybe getting more asset under management, but finding better investments, right?
Yes, I mean, that was the goal, to do the best investing job that I can make. And you can also see the two principles, they play along. Because if you just say, okay, this is success-based, but you don't have your own money on the line, right?
Yeah.
And you have a bad year, then the next year you're going to shoot for the stars,
Yeah.
right? And you might take too much risk, right? Which is then counterproductive because you can lose clients' capital, right? But if you have your own money on the line that you can lose, and it's success based only, the combination of it makes it so that you actually balance risk and reward. You're like, okay, I want to create a lot of value, but I also don't want to lose. Right? That was the second principle. And the third principle is that whenever I invest at Richtwert, coming back to having skin in the game, I said, I want to invest like a business owner. And a lot of people ask me, what does that mean, like a business owner? Doesn't everybody do that? Right? But, because the market is there and you can look up stock prices and securities prices all the time, it lends itself to trading, and gambling to some degree. I'm going to invest in this. If it doesn't go well, I sell it. If it does go well, then I add to it. But that's not what a business owner does. A business owner looks at the asset itself, right? And you can't, if you go into a business, you can't easily pivot tomorrow and say, I started a restaurant, tomorrow I'm going to start a cinema, and the day after that didn't work, I'm going to create a cruise company and have ships, right? It just, there's the transaction cost and the times to do that doesn't lend it to itself. In the stock market, you can jump from one stock to another stock every second if you want, right? So that business ownership mindset, to me, it means when I invest in a company, I ask myself, let's imagine the stock market is not there and I cannot sell for the next 5 years. Am I still happy with the investment that I have? Because it's producing returns, income, cash flow that I like, whether I can sell it or not, right? So that's one question I ask myself every time when I invest. And the second question is, I say, is this business so attractive that if the price fell even more, that I would add to it up to 30% of my family's net worth, I would be happy to put in that business. If I can't answer these two questions with a clear yes, then I stay away from it. I don't say, I go in it and I buy 5 stocks, what can happen, and I can sell again. That's not the philosophy that I take.
How do you approach sourcing of the business, and what is the filters that you apply to say whether you are going to buy a business or not? Because there are thousands of businesses in the world. You need to have a very, very good filter to say most of it I'm not going to invest in.
Yeah, I think on an overall perspective, I would answer the question with, I start with the things that I know, what I believe I know. Because I think risk comes from doing things that you don't know something about, right? Whenever you don't know something, then the element of risk becomes higher. So I want to stick to things that I understand, that I know well, because I think in that universe it is less likely that I will make mistakes. So these are businesses that I would categorize as simple. And with simple, I mean
simple
you, right? Is subjective.
Yeah.
It's very subjective, right? So it has to be something that I have a connection to. For example, like consumer businesses that sell products to consumers, right? So products that I like to purchase myself because I value what the product can do and the price and how it's being offered and stuff like that. So there I think I see the value proposition. Why does this business exist? Why am I picking this product over the competitor's product, right? Am I willing to commit a high price to it? Why is that so? How is it for me to switch from one product to another? Or am I indifferent about the offerings that are there, right? So that level of understanding as a consumer helps me to make a decision on which businesses do that. So those are, for example, consumer businesses that I know as a consumer. Other things are, because I had a career as a consultant, are industries that I have consulted with or been in myself. So from that perspective, I do think that I know a little bit more than average about those industries. So they come also into the criteria. And then, but I also have an objective criteria for simple businesses. And that's, if I can't boil it down to, let's say 3, maximum 4 factors that are the critical success factors, And these have to be stable over time. So I say, in 5 years' time, in 10 years' time, are still the same 2, 3, 4 factors going to determine over success or failure? If it's more than that, then I think the chances of being right for me are too low, and then I stay away from it. So that's how I would maybe describe what a simple business is to me. And so I start with
So you
that.
need to understand it. You need to be
Yeah.
able to essentially kind of take your understanding and boil it down to a few things that would make or break the business.
Yeah.
Right?
Because then I think once those are clear, and I'm like, okay, now I can monitor those. And first of all, when I know what those success criteria are, then I can say, okay, does this business that I'm looking at, does it have any competitive advantages when it comes to these factors, right? Or can somebody else come and do the job just as well or better than them, right? So first of all is they have to be easy to understand for me, and that means looking out 5-10 years. Second, do they have competitive advantages that are going to be beneficial for these critical success factors and increase the chances of them being the winners in 5 or 10 years' time, right? And the third thing is I look at the management. It's got to be a management team that has skin in the game. I want them to be owners in the business themselves, that we are aspiring to become co-owners of, because then I think they're incentivized correctly. They have to be skilled, and they also have to be honest in their communication. So I think, the motivation has to be right, their ability has to be right, and they have to be honest. And that's a lot of times very hard to judge when you look at the management team, because everybody markets their business well and says, why it has all these things. So I think it's important to me, at least, that they have a track record of multiple years on the stock exchange, so that I can also go and look back into the years in the past and say, what did they say? Did they actually do it? If they didn't do it, did they explain why they didn't do it? If it failed, were they honest about the fact that it didn't work and how they're going to do it? So I need to have a track record by which I can say, this is a management that I can believe in because they're able, motivated to do that. And a lot of times it's very hard. It's like a gray zone. You're like, could be, could not be. But I think the two ends of the spectrum are pretty clear. I think by now, with the experience that I have gained in consulting businesses and investing, I can identify those that are crooks because they say things that are just too good to be true, right? I mean, just experience tells you a little bit that. And then there's also the sliver, small percentage of managements where you like, when you listen to them and you look at their track record, they're just way and above everybody else.
It's the barbell model,
Yes,
right?
yes.
Yeah.
And because I invest in a concentrated way, I don't need to 100 companies where I'm like this.
Yeah, this
the
actually
management
helps
companies,
you, right?
yeah. So I'm just looking for the few managers or my few management teams that are, cut above everybody else in their honesty, in their ability, and in the motivation. So I don't have to worry about everything that is a gray zone. I can just leave that out. And once I have these three criteria, a business that I think I can understand, where I know, where they're going to be in 5 to 10 years because of the competitive advantages that they have, because I think these competitive advantages are actually enduring, and they're led by a team that I believe in, that I admire, and they sit in the same boat with us, then I think this de-risks the investment case a lot. And then the fourth criteria that I look for is I want to make sure that if I made any mistakes in the first three, I still want to be protected. And that's the price we are willing to pay. So I look for a margin of safety, just like a mountain climber that goes up, but is capable of climbing a mountain, but still has security in case they slip, in case the weather becomes difficult, in case a bird flies by and distracts them, or whatever it is, right? You want to have a margin of safety that when you make mistakes, or if the future looks different, because the future is unpredictable, you still want to have your downside protected. And that's the margin of safety. So I value those businesses because if the first three criteria are given, I think I have a good chance of getting an estimate of the intrinsic value of the business. Like a private owner, I say, well, what would a reasonable businessman or woman that understands this business and can take it to somewhere, what would that person be willing to pay? And that's usually a range. And only afterwards, I look at the stock market and say, okay, but what does the stock market price this business at? And if I say, this business is worth between 15 and 20 billion or million, doesn't matter, and the business is available for 17, then I'm like, okay, I don't really have a margin of safety, right? But if that same business that is worth 15 to 20 billion, if I can buy it for 4 billion in the stock market, then I think we have a huge margin of safety. And I can make a lot of mistakes and the environment in the future can look very different. We're still very low risk in our investment. And if the first three criteria were right and we bought it for 4 billion, then we have a very high upside. So that's the other thing that is a little bit in the stock market. People think, if you want to have high returns, you have to take high risks. And that's not correct, because if you take a lot of risk, the magnitude of outcomes becomes wider, right? You can have very good returns, but you can also have very high losses, right? So it's just the spectrum increases. It doesn't mean that by taking more risks, you will have higher returns. But this approach that I just described, with the margin of safety in the right businesses led by the right management, you can actually lower your risk, and on the other hand, you can increase the chance of higher returns. So risk and return not only don't always correlate, they can also reverse correlate with each other.
So the first three criteria that you describe, it's a filter. If a business fails on the first three, you basically just throw it away and say like, okay, I don't want to proceed with this. The last one is actually a judgment or a quantitative call. You are thinking, you take these businesses, likely you put them in a backlog and you say like, okay, if it's too expensive, I'm gonna look at it at a later point in time. So all this work that you did is not lost. That's also kind of quite useful to have. But then afterwards, the way I would see this is, the more you understand the business, the lower margin of safety you would need. How you kind of make a decision whether 10% of margin of safety is enough for you, or you need like 25, or you need 50%.
That's a very good observation. If you have perfect insight into a business, you know exactly why it succeeds, why nobody can compete with it, what it's going to look like in 10 years from now. Let's say you have 10 out of 10 insight, then you don't need any margin of safety, right? You shouldn't overpay for that business, but you can pay a pretty high price for it. And the less you understand, the more margin of safety you need. That's absolutely right. So the way it turns out for me, because investing knowledge and business knowledge is accumulative over time. So when I look at businesses that I understand well, yes, I do insist on lower margin of safety. I prefer it to have higher margin of safety, because that means we're getting it even cheaper. But the more confident I'm about the quality of the business, the higher price am I willing to pay for that business too. So yeah, the margin of safety is really a risk management tool. Investing, this is what Warren Buffett always says, it's like playing baseball, right? But the only difference is you can't strike out, right? You can stand there and people pitch balls at you and you're like, maybe I should hit this, but it's not in your sweet zone. You can just wait until something comes, and it's a business you really understand well, right? You believe in the management and so forth, and the price is so attractive that you can't say no, right? So you can be very patient with doing so, but you also have to, on the other side, you can also miss out, right? So, let's say you find a business that you think is worth somewhere between 15 and 20 billion, and the market offers you the business for 8 billion, right? So you say, this is a very good margin of safety, but I would really like to buy it at 4. billion, right?
Right.
Maybe the market does you the favor in the fast to fall, but maybe it doesn't. And then that opportunity is gone. So you always have to, that's also what makes investing so interesting, right? That you have risk on both sides. You have the risk of committing to something and making a mistake, but you also have the risk of omitting something and saying, I want it to be even cheaper, and then missing the returns that it would have produced.
So far we talked about like your process of selecting a business. Now the question is, a portfolio is a different thing. It's a combination, like you have a bunch of things you want to have. I would be surprised if you had many positions, right? So I'm just wondering how you think about how many businesses do you own, how do you size them?
Well, typically the range that I feel comfortable with is somewhere between 5 businesses and 15 businesses. If it becomes less than that, less than 5 businesses, then I think the risk of things that can happen in the future, and they can be then catastrophic for your wealth, increases significantly. So you have to be very, very, very sure of what you're doing when you're investing in less than 5 businesses. And more than 15, I don't believe that I can have the enough conviction, enough time and analysis and knowledge about the businesses, because I have to cover so many businesses. So that's the sweet spot that I feel comfortable with. And then where we land between the 5 and 15 really depends on how many opportunities are being offered that I can understand. Right? Sometimes the market is offering a lot of good companies that I think I can understand at attractive valuations, and then I feel fine to diversify more and have more. And sometimes the differences in quality and the valuation, so the margin of safety, are so large that I say, we should put more, or I should put more in my best 3 ideas, my best 5 ideas, my best 8 ideas than in everything else. Because nobody really gets rich with their 20th best idea. Like if you look at business people, those that really were very successful,
right?
They have one business that they're very successful with, right?
But there's a lot of luck involved there, right? Like
there's a lot of luck involved, and of course they're running the business themselves.
And it's kind of selection. You kind of look at people who succeeded, right?
So in investment management, I think investing is most successful when it's most business-like, but because we are passive, we select the businesses, but we don't really, I don't really have a say, and can't go say, Apple should now do this and that. I can't influence them, right? Somebody else is making those decisions, and because of these 2 things, I think a little bit of diversification, or diversification in general, makes sense. But a lot of times in the asset management industry or in the fund industry, diversification is taken to a level that is way beyond beneficial, right? Because at some point when you have, imagine, let's say you have a universe of 100 businesses in an index that you're using as your benchmark, or you have 500 businesses, right? So if you have a portfolio that consists of 100 businesses, right, you already have 20% of the entire universe, even if it's 500 companies large, right? And the average holding length of an asset management company is less than a year. So if you do that for 4 or 5 years, those 100 companies go back, somebody picks another company and so forth. So after 4 or 5 years, you basically have the entire universe in your portfolio, and then you're going to have the performance of the portfolio, of the universe. You just get the performance of that. And that's before fees. After fees, you're going to be worse, right? So I think concentration makes sense. You make money with the things that you understand well, and you get rewarded by focusing on them. What are your best ideas, and betting heavily on those.
This kind of forces you in a situation where you need to understand everything you own, and then why you own them, what size you are owning them, and it's all you. You don't have a committee, you don't have someone to check it with. How do you distinguish this from being reckless? With your own money too, right?
Yeah,
it's also on the line.
Yeah, no, absolutely. No, I think I go back to the business ownership mindset and having skin in the game. I do not believe you can outsource risk management. I think the person who makes the decision should also be the person who manages the risk, because at the end of the day, they're responsible for it. Now, you could argue, isn't that better done if you have more intelligence in the number of people and analysts and portfolio managers and a committee that decides? My experience has been, or let me say, there are two things, two observations. One observation is, if you look at the last 200 years, who were the most successful investors that existed, you will find it very hard to find a team. There's almost no team that is among the top 20 investors in the world. They're always one person, maybe two people. Mostly they're one person, right? So that's the first observation. Like, the best investors are singular. They're one captain ships. That's one. And the other thing is what I mentioned to you, right, when we talked about the Apple story where I had to put in the veto. And we discussed it, like, to have above average performance, you have to be right and you have to be different, right? And if you think about it, I mean, we, all humans, as much as we think we're independent and think alone and can decide alone, we all follow a herd mentality to some degree. Some people more, some people less. So, and then in the market, it's very important that in situations where you think you're right and almost everybody else is wrong, where you have that conviction, then you also have to be decisive and to be able to take actions. And as a human being, it's always hard to do, because you're like, all these important people, or
maybe I should check,
yeah, maybe I'm not right. You start to doubt yourself, right? So let's say the probability of you in that situation where you should really invest in, where most people or everybody else is disagreeing, let's say the probability is 40% that you will do it and 60% that you will give into the herd mentality and not do it, right? So that's you alone, 40%. Now imagine you have an investment committee of 5 people. Let's say they're all more or less like you. Like, everybody has a chance of 40% of making that decision. And you 5 have to come to an agreement. So now you have 40% to the power of 5, which is a much lower probability that the team says, unanimously, yes, we should seize this opportunity and invest. And that's what I've seen. I mean, investment committees, most of the times, the consensus decision is a lukewarm, average decision that comes out. It's not a high conviction, contrarian decision that comes out.
I mean, it's not like you're swimming in ideas also, right? Like, you maybe have 15 good ideas, and if somebody kills one, 3/4 of them.
Yeah, it just becomes, it's just
situation.
Human psychology. And the other thing, don't forget, incentives decide how behavior is done. When you're not the person who makes the decision, but it's the committee, you can also hide behind the committee. Like, okay, let's take it, because
somebody else is saying it.
If it doesn't turn out right, it wasn't you. It was the committee. Right? You can say, but the others also agreed with me that we should invest in this, or the others also agreed that we shouldn't invest in this, right? So it's much easier to hide behind the crowd. And I think it takes more conviction, and it takes more
believe in yourself, pretty much,
responsibility.
Right?
Responsibility to say, I make this decision because of these reasons, and I'm sticking to this. And if I'm wrong, I will admit that it was me that was wrong, right? And to me, it was always important. I mean, I call my clients my partners, because I really believe we're in a partnership together. And I tell them from the beginning, this is a one captain ship, but it's purposefully built like that. So if you're successful, you know who made the success. And if it failed, there's nobody that I can hide behind. You know that it was me.
Right. That also helps you in selecting the right clients that they believe in you, right?
Yes, I mean, most clients or most people who might be interested, generally investing, when they come across me or Richtwert, they might say, this is one person. No, do I want to do this or not, right? So I think it creates an environment where they really have to do the same way that I go about selecting in businesses. They have to also do this due diligence with me and say, is this a person that I trust? Do I understand the approach of investing that he has. Do I believe that this investing approach can create value over time? Do I believe that this can minimize my risk, right? And if they don't have that conviction, in my setup with a one captain ship, they will stay away. And that is good, because not because I'm like, okay, now you made the wrong decision. I actually encourage them and say, I will give you all information that you need. You can ask me any questions. I have a partner manual that explains exactly my investment approach. And I give all this information out, and there are the letters that I write every year. I say, look at those and decide if it's for you or if it's not. I'm just as happy if you say it's not for me, because it's not for everyone, right? And if you do think it is for you, please decide, because I only have one strategy. I don't have 20 funds and hoping that, I can raise more money, or at least one of the funds is going to do great in every year, because I have 20 ships on the sea to see which one does well. I have one strategy, one fund that I manage, and all my best ideas go into there. Lowest risk, highest reward potential. So they can decide if it's for them or if it's not. There are many other people and asset managers that they can choose from. And if they do decide Richtwert is for them, then they can decide how much of their wealth and savings they want to put in. I have clients who say, I will give you 5% of my assets. With the rest, I'm going to do other things. I have others who have entrusted 100% to me. And that's absolutely their decision. But I don't customize the strategies and the portfolios to the clients. I believe in doing one thing and doing that right, and everybody can decide if it's for them or not. Actually, many of my clients are business owners themselves. So they're either still business owners or they just sold their business, but they come with a business ownership mindset, because they have seen, I took this business from here to here, and they know how they did it, and they know, the investment was successful, that they put the time and the money they put into their business was successful because the business was successful, right? So they can associate and identify with the approach that I have, and they're more likely to say, this is an approach that I want to know.